Monsoons, another step in economic revival. Monsoon rains are expected to hit India's southern coast on May 27th, which is not far from now, 5 days earlier than usual, making the earliest arrival in at least 5 years, according to the Indian Meteorological Department, which also obviously raises hopes of bumper harvests of crops like rice, soybean, and corn, according to a Reuters report. Last year, the monsoon reached the Kerala coast on May 30th, and overall summer rains were the highest since 2020, which also helped India recover from a drought in 2023. The monsoon provides about 70% of the rain that India needs to water farms and recharge aquifers and reservoirs. Reuters points out nearly half of India's farmland without any irrigation cover depends on the annual June to September rains to grow a number of crops. Summer rains usually arrive in the southernmost coast of Kerala state around June 1st and then spread across the country or move up the country by mid-July. And that process usually triggers the planting of crops like rice, corn, cotton, soybeans, and sugarcane, says Reuters. The IMD, or the Indian Meteorological Department, last month said that India would see above average monsoon rains, and this would be for the second straight year, that's in 2025. Of course, there are some questions about whether the rainfall would be consistent, and we'll come to that in a moment. The IMD defines average or normal rainfall as ranging between 96% and 104 or 104%, or a 50-year average of 87 centimeters or 35 inches for the 4-month season. So, with the monsoons being among the major macroeconomic data points that are looking good and favorable, what are the other major macro data points looking like, and how is India poised as we examine our internal and external economic positions now that some things have settled down? I reached out to DK Joshi, Chief Economist at CRISIL Ratings, and I began by asking him how India's macroeconomic data was stacking up from here on.
As far as I think the monsoons are concerned, coming early or a little bit late doesn't matter too much for agriculture, at least we've seen in the past. What is really important is that both the private agency SkyMet as well as the IMD are predicting normal monsoons this year. And this is the first set of good news for agriculture output, because food inflation depends on that. Agriculture production is about 18% of the GDP. So clearly from agri growth and food perspective, I think it's a very important signal, first set of signal. And it comes on the top of production of wheat, which is expected to be healthier this year. And also I think pulses production is also expected to be good. So these are the Rabi indicators from the second advance estimates. On the agriculture front, we have good news. Having said that, I think I also want to point out that this is specifically important this year because the external environment is not that great. So the domestic factors assume greater significance in this context. But I think having said that, we need to watch out a bit carefully on how the rains play out, because we've seen that the monsoon patterns have changed, there are heat waves, etc. So all those things will always remain monitorable and they'll bear watching. And I think apart from that, early rains can bring some respite from the hot weather that is currently playing out. So that's on the agri front.
If I were to ask you about food inflation, in the past, food inflation has been driven by factors like vegetable prices, including onion, potato, tomato, which have fluctuated quite wildly. And part of this, or a good part of this, I imagine, is driven by rains. But is that something that we are in more control of compared to previous years?
See, I think weather is unpredictable and the food production responds to that, I think, and it's very sensitive to that. So I think we have become more resilient in some of the crops like rice, wheat, etc., because we've introduced new varieties. I think this is an ongoing process. And what has also happened is that the frequency of these weather shocks has also increased while we become more resilient. So it's a interplay of both these that determines. But for this year, I think the tidings are happy, so far.
When I talk to analysts, for example, on the equity side, a lot of people are hoping or maybe placing their hopes on how companies will perform. I'm talking about consumer product companies on the back of an agriculture upswing. Is that something that you're also seeing?
The rural part is better than the urban part right now. And the durable goods are doing much better than the non-durable goods. That's what we get from the industrial production data. So I think now the issue is the revival of urban consumption demand. And here I think so far, whatever stimuli is being given, I think has not played out because the interest rate cuts just began and I think they will take time to influence the urban consumption. And on top of that, I think the income tax cut have just started kicking in from April. So I think in the coming months, there is hope that these two factors will support consumption demand. And on top of that, I think the low food inflation is specifically good because since it has a very large weight in the consumption basket, it eats into your discretionary spending ability. So I think if you have low inflation also, then I think that comes in to support your consumption. So I'm not talking about a very strong revival in consumption, but what I'm saying is that will maintain its momentum, I think. And the hopes are now pinned more on what happens to urban consumption because rural signals are reasonably good as of now.
Right. So if I were to visualize, the classic ducks lining up in a row, at least as far as good macroeconomic data is concerned. So we've touched upon monsoons, which, as you've pointed out in the past as well, is a luck factor in some ways or a lucky strike. But there is also inflation and there is interest rates, and you've touched upon inflation already. Interest rates is the third aspect or the third duck. How are you seeing that, and what are the other ducks that you feel are lining up right now?
First of all, I think if you put it in the global context, let me just spend a minute doing that. We are a domestically driven economy, so what happens to consumption and investment is very important. Also, keep in mind that global factors currently are not that favorable, and we have direct impact and indirect impact of what happens in the tariff regime that is playing out. And direct impact is, of course, linkages with US, but indirect is the collateral damage because even if you tariffs did not hit you, I think the collateral damage from what happens to the other economies, whether China starts dumping, which I think there is some indication. So all those things start playing out. So in this context, what happens in the domestic economy in terms of both buffers as well as the growth levers or growth drivers that we have becomes very, very important. And people usually don't talk about buffers when you have those in place. We have a low current account deficit, a low external debt, forex reserves are reasonably healthy, and these are a cushion, I think, in the current environment where there is a lot of volatility. Rising share of services in exports also is a cushion for us because the interestingly, I think the cycle of services exports or services trade is not so much synchronized with the global trade cycle. Here, I think the services exports have done reasonably well compared to the goods exports whenever there is a global trade downturn. And again, if you look at the latest forecast from the WTO, they are also predicting that goods trade will be down by something like 0.2% in 25, but the services trade will still grow at 4%. So that, I think, having about 48%, so that's another buffer. And finally, I think the healthy corporate balance sheets, I think they provide the financial flexibility as well as resilience to the corporate sector. The upgrades continue to be more than downgrades, interest cover, gearing, all those parameters are very healthy. I think in this environment, policy levers are not too many. I think one is what you just referred to, interest rates. And here I think we see two rate cuts happening in the rest of the fiscal year. And that's because your inflation is nudging down, and I think the data is likely to come on 12th, and we expect headline inflation somewhere around 3%. So that's pretty soft. Government, I think, on its fiscal lever is not that strong, but they have budgeted 10% growth in capex. I think if they carry that out, that also becomes a stimulus compared to last year because last year the government capex performance was not that good. Oil price is also another luck factor because we don't control it. So that is good for growth, inflation, and also current account deficit. So we actually expect about 6.5% growth in 25-26 with risks tilted downwards. Now, the biggest or the top macro risk for us is higher tariffs and uncertainty and financial market turbulence, which can create a downside to both global growth as well as, I think, to our growth. We need to continuously watch out for weather disturbances because right now we know about quantum of rainfall, but its distribution, the shocks from the weather need continuous monitoring. And I think the experience of last few years tells us that food inflation, which is anyway most volatile component of overall inflation, I think that is most sensitive to weather changes, and fruits and vegetable particularly is. And I think finally, the policy making is becoming more data driven across the world now. Very difficult to forecast in this environment of heightened uncertainty. So you'll have to keep monitoring it on a regular basis. So I think that's how I would look at the outlook play out and the risks, I think, which are there in the system, and I think which need continuous monitoring.
So when you look at the buffers that you've talked about, the low current account deficit, external debt, high forex reserves, very close to record actually, which was hit in September, I think, last year. And the other factors that we've talked about, lower oil prices in the 60s, we've talked about inflation obviously being lower and interest rates heading further down. Do you recall a period that you've seen that's similar to this in the past, and what happened after that?
Well, I think I'll have to jog my memory, but I can tell you a period when things were opposite of this and what happened. For instance, the 2013 taper tantrum, current account deficit 4.5% of GDP, inflation close to 10%, growth not that strong. So I think you were obviously fragile five, and you got impacted very badly. And now actually the macros are telling you are far away from that. And also I want to tell you that the way global developments impact us, I think is a function of the nature of those developments. During the global financial crisis, where the advanced countries, particularly the advanced countries, that slowed down, actually they were all in a recession, very sharp slowdown in growth. India still had a positive rate of growth because it was not a crisis that was within the economy. I think consumption, etc., continue. But if you take a crisis of COVID, I think our economy shrank more than the advanced countries. So I think it's the nature of the crisis also. So right now, what we are seeing play out in some sense is closer to the global financial crisis, where it's not a crisis within the economy, but I think it's a global shock. So the impact will not be that pronounced. I think so. The nature of what kind of shock comes also determines. So this one seems to be, as of now, a relatively benign shock, I think, in comparison. And our macro parameters are in good shape, so you can at least, you're somewhat resilient. By the way, I think this doesn't insulate us from the global economy because over the years we've got more integrated. So the pain very quickly transmits from what happens in advanced countries to us. So in that context, we are not insulated, but we are better cushioned, I would say, at this juncture.
You mentioned COVID and the fact that our economy performed worse, was more hit than many of the developed countries who also were shutting down or locking down. So is there a sort of one-line reason why that happened to us? I mean, we were more affected.
Everything came to a halt within the economy, and those countries gave more stimulus than us. I think that's also true. And they also suffered the consequence of that in terms of higher inflation, particularly US. I think it became quite unpredictable. So I think their ability to give stimulus was much more than our ability.
So in retrospect, it's blessing, at least a minor blessing.
Well, I think there is if you look at the cost benefit analysis, I think, yes, I think the policy package of focusing on investments and pulling back or giving stimulus to the extent we can afford, I think that has helped.
So speaking of investment, so using now all of this, which is clearly, as you said, a relatively favorable environment, assuming there is no further escalation on border conflict, the tariff numbers that we finally see are okay or manageable. What's your sense on how this could drive overall investment and expenditure, private and public?
As far as investment is concerned, the best case would be that investment to GDP ratio in 25-26 remains what it was in 24-25. Now, government investment will do better than what it did last year because in 24-25 we had these prolonged elections, and I think that had an impact on public investment. So public investments haven't done that well in 24-25. This year, I think there'll be more focus on that. So the capex from center and state should do much better than last year. Now, coming to private capex, which we have been waiting for a long time. Well, we all know that the private capex has not picked up in line with the healthy balance sheets and financial flexibility that the corporates today enjoy. And increased uncertainty has now made it even more difficult to take decisions on investments. For instance, a fear of dumping means that you don't know how the demand is going to play out, how much competition will be there. So I think private investment is likely to remain subdued. And interestingly, there was a private capex survey released by NSO about, I think, a few days back. And this is an experimental survey, but it's very important for going ahead because we'll have more handle on what is happening to private investments. And I think that shows that investments, even the private sector, are lumpy in nature, and also shows that 25-26 investments are likely to remain subdued. Now, I think I just want to point out that this survey was experimental, and I think data needs to be interpreted with care. But this is what it is showing. And I think that is our assessment also, that in this highly volatile and uncertain environment, I think private investment will not be that strong an engine of growth, certainly. But I think there is an interesting twist to this whole story on investment. While the private investment may not be that enthusiastic, but what we are seeing is that because of the supply chain shifts which are happening as a result of the trade, there is some positive spillover to us. One example is the Apple announcing that iPhones will be manufactured in India. So I think that will have a demonstration effect on some other companies as well. And I think so they will, as a part of the supply chain shift, we will benefit from that. I think I heard in your show that I think the Vietnam's EV manufacturer is also going to start production this year itself. But the supply chain reorientation, which did not benefit us in the previous China Plus One, now seems to be somewhat more favorable, I think. So we need to latch on to this trend and quickly make a success out of it as much as we can. I mean, from a long-term perspective, we'll need to do more, better infrastructure, etc. But within the existing system also, I think there seems to be an opportunity emerging from that. So that's also an investment, I think, which is coming from, although overall FDI is not that strong.
But you are saying that with someone like an Apple, who, by the way, has said that they want to move all their production meant for, or rather consumption meant for the US to India from China, is also triggering domestic capex because they're feeding.
So what will happen now is that one is that we are in the assembly business. I think we've done a very good job of that. Now I think you need to move, some backward linkages will start as a result of that, because you'll have to create an ecosystem for sustainability of this kind of investment.
Right. DK, it's been a pleasure speaking with you. Thank you so much for joining me.
Thank you so much, Govind, for having me.